Coming up on the SBS on the Money podcast, we take a look at the gender pay gap between public and Commonwealth Bank continues to outperform. We'll take a closer look next. Hi everyone, it is Wednesday, the 21st of May 2025. The Australian share market closing higher today, the S&P ASX 200 up 0.5%. We'll have a look at the details with James Whelan from Barclay Pearce Capital in a few moments. But first to the gender pay gap, where a gender-balanced management team in public sector workplaces is helping to address the gender pay gap. The government's Workplace Gender Equality Agency analysed nearly 120 employers in the federal public sector and found an average gender pay gap of 6.4%, which is better than the 21.1% recorded in the private sector. It means women working in the public sector earn, on average, 94 cents to every dollar made by a man, and that's about $8,200 less per year. For more, Rhayna Bosch spoke with Mary Wooldridge, the CEO of the WGEA.
It is a very positive result. When you compare to an equivalent private sector number, the gender pay gap is 21.1%, so 6.4% is obviously substantially lower than that. But our target range, both overall and for individual agencies, is plus or minus 5%. We want to converge to zero for the gender pay gap. And so there's more work to do across the board and for some employers within the public sector as well.
You mentioned the discrepancy between the public and the private sector, and as you said, it is quite substantial. What's behind that?
One of the positive things we see with the public sector is that at all levels of management, we have a balance of men and women. That's at least 40% women, at least 40% men. This is in contrast to the private sector, where we don't have such a balance, and particularly we see more men in those higher paying roles.
Just to contextualize this further, I mean, there are other factors at play here, things like care responsibilities, other benefits like bonuses, for instance. How do they feed in?
Additional payments beyond the base salary are an important contributor to the gender pay gap, both at the public and the private sector levels. We see in areas such as the Federal Police or Australia Post, where overtime is quite a regular contributor, that they are significant additions to the gender pay gap. And obviously, many more men are getting access to those options for additional work and additional pay. So it is important to look at the barriers to that and make sure that both men and women have equal access to those opportunities for additional work and additional pay.
You mentioned some of the barriers there. What are they?
So the barriers can be numerous. Sometimes it is just time and the availability to be able to work extra hours, especially if you have caring or family responsibilities. And so it is important that there's flexible working arrangements that are available, whether that be the ability to work from home in some instances, but that's not always the case. It could be being able to work compressed working weeks, job share positions, or even be able to adjust your hours of work. A very important and interesting outcome from the results we've published today is a much higher level of full-time employment for all people, and particularly women in the public sector. And we attribute that to the availability of flexible working arrangements so that people can balance both having a serious career and working in the public sector, but also being able to manage other responsibilities that they may have. We need to continue to provide opportunities to encourage participation in the workforce at the level that people want to and are able to work.
Now, despite all of this, some of the sectors that have a very large female headcount or female-dominated industries did present with some larger pay gaps. Can you talk us through how this kind of breaks down on a sector-by-sector basis?
We do see a lot of similarity in the public sector that we see in the private sector, where even in highly feminised industries, there can be high gender pay gaps. And what's often driving that is when you have a lot of women, but only a small proportion of men, that the men that are there that are working are in the higher paying roles. And when you look at a median gender pay gap and you compare median salaries of men and women across the board, the smaller number of men are higher earners and women are earning across all the pay scales. What's important to look at, and there's been a lot of focus on getting more women into male-dominated roles, is we also need to think about how we encourage men into the full range of jobs, which include those that have traditionally been women's roles, and particularly caring, social services, administration and support, those sorts of things, and create opportunities for all people to be able to access a full range of roles, and in doing so, be able to address some of the big gaps in gender and pay that we see.
That's Rhayna Bosch there speaking with Mary Wooldridge, the CEO of the Workplace Gender Equality Agency.
Now, Market Day on the SBS On The Money podcast.
Another day of gains for the Australian share market. The S&P ASX 200 up 0.5% to 8,386, driven by utilities and healthcare. In fact, of the 11 sectors on the S&P ASX 200, 9 rose. The worst performing industrials, down by 0.7%. Another stock in particular making news today, the Commonwealth Bank shares hitting another record high. For that and more, I spoke with James Whelan, the Managing Director at Barclay Pearce Capital. James, run us through what's driving the market today.
A little bit of a sugar rush happening in the old Australian market today. We've seen wages and bonuses increase through the month of March, coming up by about 6%. But we've also seen it's the aftermath of the 25-point rate cut by the RBA, along with the general de-tariffication of the markets and general good sentiment coming out from company news as well. Led by the financials, we are seeing a nice little rally on the most expected RBA cut this year so far.
Let's break some of that up that you've just mentioned. First of all, the rate cut. Any change to market pricing for future cuts?
Still holding at 2 cuts for the rest of the year, in line with what the RBA is saying and in line with general markets as well. And most analysts too, all agreeing with that. We find that that's pretty much in line as well. And we can see that as being very possible with the idea of slowing inflation, but also with the cautious outlook for the global economy.
Speaking of the global economy, what about the US? How are you viewing it and its economy? I saw James Hardie today saying that there were concerns about a slowdown in renovations there, in particular with referencing a new deal that it's having with a renovations company. Is this a sign of the way the US economy is tracking?
I think that there's a forecast with the US that's being a little bit underdone at the moment. Here internally, we see that the US economy is strong now, but potentially weak. What has happened with the tariffs that has been brought in over the last month or two, even though they're being rolled back, has meant that a lot of small businesses have not been able to make in pre-bookings and build up their inventories into the next months, and even going forward into Halloween and Christmas season, that they're going to be behind. We see that that's hurting small businesses. Large businesses can, to quote Donald Trump, eat the tariffs, but smaller businesses are going to suffer for that. When small businesses suffer, economies suffer. And we see that that is potentially the next big swan event that's coming up in the US. So James Hardie, when it comes to renovations, probably in line with it talking their book, but we can see that across the entire US economy, it's going to be pretty similar.
Can we spend a bit of time talking about financials? You said financials doing well today, in particular the Commonwealth Bank hitting another record high at a time when, and we've spoken about it numerous times with many analysts over the past few weeks about the Commonwealth Bank reaching these record heights, despite the thought that it may be overvalued or expensive as a stock. I've been taking a look at its market cap. It's almost $300 billion. BHP is the second biggest company on the market, valued at around $200 billion. Remember the days when it was changing, that top between BHP, CBA and CSL? So it's blown the lights out, right? It gets larger. Run us through why this is happening. Does it have anything to do also with the potential for the outlook for interest rates? And what's your take on the company right now?
Well, there's a lot to unpack there. I think that you and I have been talking about the price of these particular stocks for a long time. CBA just keeps going and going and going. If you break it down to a few little reasons as to why. First off, they're 20% of the mortgage market in Australia. So a 25-point cut, continuing immigration, we've got an Albanese government, nothing is really going to be changing in that regard. Yes, we're going to see more housing, more loans, more growth. Fantastic. CBA is also amazing at protecting their NIM, and amazing at covering their technology and growing beautifully. They own the Eastern Seaboard. That's fantastic. That's a classic CBA story. That's great. Also keep in mind that they are the largest cap stock in Australia. So no matter what happens, if you want to go down to a basic fundamental, that 11.5% of super funds, if they just invest in a nice lazy index ETF or index funds, they've got to invest in the Commonwealth Bank. It's always going to get natural flow for as long as there is growing wages and any wages, and as long as the Australian economy is okay, the Commonwealth Bank is always going to get a natural flow from the market to go into it, which is fantastic. And then you've also got the fact that you do have the unwinding of these massive risk areas across the globe. Natural overseas money comes into the CBA too. Interest rates coming down globally, more or less, will also help the case too. But so de-risking just means that the natural flow CBA gets from global funds, from local funds, is good, along with the sugar rush to the housing market.
What about that argument that it's very expensive in terms of a stock? Are there any negatives there?
CBA has always been expensive. It's currently up around a 30 times price to earnings ratio. Not that you should really be rating banks in that regard. Most US banks trade around that 9 to 11 times. So that's something to compare everything to. Yes, it is overvalued, but you do a little bit of homework and you have a bit of a look. About this time last year, it was trading about 24 times. It will continue to do that and continue to beat. Would I be buying it here? Probably not. But definitely be looking for the next dip to be able to pick it up. And there was one just recently to be able to grab hold of it. The dividend yield is down to about 2.4%, I think, as well. If you're going to be buying the banks, and a lot of the old guys do, if you're going to be buying the banks for the div yield, CBA is probably not where your best bet's going to be at the moment. So just maybe wait for that to come back, or wait for more news on dividends to come out through that, or do what most people do, which is buy and hope that the dividends are going to get increased or raised. However, historically, looking at that number, it's not there for the yield. You're buying it for the growth right now. Is there much left in the tank? I don't think so.
Any other corporate news you're keeping an eye on today?
Main Pharma, a little bit of a jiggle. Looks like some of the people that were looking at purchasing them, having a review, pulled the rug out from them, and they've taken a really nasty hit as well. Aside from that, Santos, have a really good look at that. A bit of a bubble going on in that as well. A lot of shorts in Santos unwinding too. So watch for some sparks in that regard. Still keeping a very close eye on copper, commodities, anything in that regard. Strength from China. Again, mentioning the de-tariffication of the world. If, and this is probably not going to happen, but if by some miracle trade deals do get to be worked out around the world, we're going to see that back to the regular growth that we were seeing before Trump's tariff liberation day. And then China's off to the races, which means that copper gets back on the right wagon, and we're going to see the rest of it. Uranium, have a look at uranium too in the commodity space. Some amazing things that are coming out in that area with European countries unwinding their anti-nuclear stances and looking to build. We're seeing that uranium is getting a bid here as well.
And finally, you've mentioned some of those areas there, but what are you telling your clients at the moment in this investment environment?
Stay invested. It's what we talked about through the Liberation Day and onwards. We're probably selling pops at this particular regard, whereas the last couple of months we've been buying dips. So just take it easy with the valuations. Well, like we said, tariffs can be turned off with a tap, on and off. However, the ramifications of what happened will be lasting for the next few months and potentially for the next few years. All eyes on anything that you see with regards to slowing growth in the US, inventories down as shelves start to get emptied. We're looking at 4th of July sales as well over in the US as being the trigger for what could happen maybe with a really big slowdown out of the US. So eyes on there because they haven't been able to stock their shelves quickly enough. That's a real thing that I think that people are going to start talking about over the next few weeks.
James Whelan there from Barclay Pearce Capital. Don't forget, if you enjoy the podcast, to give it a rating or review on Apple Podcasts and Spotify, and to click subscribe.
This SBS On The Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It is not personal advice, and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decision.